Good evening, ladies and gentlemen. Welcome back to Stocks to Buy Live. Today, we're going to actually preview a crap ton of information that is available to us. We're going to talk about efficient market theory. I want to talk about the price to earnings on the variety of ETFs that I own, including the broader market, to get a better idea of where we currently stand. Because so many people think we're in a bubble. Are we going to correct? Are we overbought? Nobody really knows, but I think we can just kind of get a clerical view and talk about this from a really intriguing manner. Now, my portfolio, as much as yours, it's probably been going to the moon. And those that are in their retirements and those that have assets are probably pretty pleased, which is going to help stabilize the market for as long as this continues. Hell, I know people, I've been hearing stories. I'm sure you're hearing it from all kinds of people. They're taking profit on their stocks. They're buying cars. They're living their best life. I mean, there's probably a lot of people. I'm a small fish. I'm sure most of us watching this are medium to smaller fish in this pond. And for the money that we're making, I'm sure the whales out there are, ever around getting fatter off this, which is just crazy to consider here. But what I was doing in my video last week is I was throwing a little bit of shade, and I was being kind of hyperbolic around some other influencers on like this goal of kind of, fast tracking financial independence and trying to retire early. Cause I'm not trying to dick around. Like, I'm not really trying to over enjoy luxuries like coffee and stuff like that. So when he said, oh, does it really matter if you spend a few bucks on a cup of coffee if it makes you happy? And, I made a stupid joke, obviously saying, yes, it obviously matters. And I was just kind of referencing the whole idea of Starbucks, right? Because if you work 5 days a week, 240 days a year, not including holidays, whatever, you're probably putting about, $1,200 a year into a $5 coffee, which is nuts. And that's just buying one a day. Over 45 years at a 10% S&P 500 like return, you're talking about almost $1 million, right? And that is just one aspect of the pool that you need to be paying attention to if you're trying to like actually fast track your independence. You only have two things you can play with: income. And for most people, income is hardly controllable. Most people are, they have their salary positions, they might have some side hustles, but most people aren't starting multi-million, billion-dollar businesses every day, right? So controlling income is a lot harder, in my opinion, than controlling expenses, because most people can just go out and get a job starting 50K a year. Hell, most jobs at a college start as interns and, boring ass, not that much higher salaried positions. So the one thing you can pay attention to is the coffee you're buying, the food you're buying. And yes, I get if you want to enjoy something in life, if you like cars, if you absolutely love coffee, find one thing you enjoy, spend a bit of money on it, splurge. But you can't be that guy that's like, I want new shoes and new clothes this week, but I also want to go to the restaurant with my friends and I want to party and club and drink and buy alcohol and have Starbucks every day. Like, when you look at your expenses being the most controllable and you look at what one Starbucks coffee a day turns into over 45 years, imagine if you do exactly what I did and you just sit here patiently and you look at your bills and you're like, oh, I could probably call the phone provider and bitch because someone's offering a better phone plan and they'll lower the cost. You look at your internet, your auto costs. Like, am I driving a brand new car? Do I need a brand new car? Buy a used one. You don't have to get it from a dealership. I mean, there's so many things that are controllable that you don't realize how $5 here, $10 there. Like that old saying, if you pay attention to the dollars and cents, if you pay attention to the nickels and dimes, the dollars tend to keep care of themselves. And that's kind of what I like using with this compound calculator. It's like literally the stupidest, simplest thing that you can look at and get a full base in a very realistic way where you can be with small chunks of change. And then again, I always recommend playing around with this. And, if you're like me and you're nuts and you want to try and put away 50% of your income and, you find a way to stack maybe 30, 50K a year, let's just keep it like even 2,000 a month, or just we'll say 25,000 a year. If you can pull that off over even like a 15-year period at 10% is almost $1 million, right? So, this is why I like showing people this, because it becomes very realistic for people that aren't even making a huge amount of money to aspire to, getting in a place of comfortability. You just got to find your balance, right? There's nothing saying you can't go get a fun job on weekends either. You want to go to the club, get paid to go to the club. Become a DJ, find a way to get into bartending, entertainment, find something that gets you there where you feel just as good. But putting that aside, I really want to talk about efficient market theory. And then I want to kind of bleed into the current price to earnings multiples and how we look at the market today. Because again, we've seen people like me, Kevin, try and short the market right now. We're getting a lot of bearish sentiment out of a lot of investors across the board. I see people stacking cash again. But the idea is the efficient market hypothesis. It's late, folks. It's Sunday. Tomorrow's a work day. Damn it. Let's get our shit together. This hypothesis in financial economics that state that asset prices reflect all available information. A direct implication is that it is impossible to beat the market consistently on a risk-adjusted basis, since the market prices should only react to new information, right? This is the idea that with all the information that is currently present, that the S&P, like most stocks, are favorably valued of all the information and earnings that we currently have today. So when we're talking about, because so many of you are asking me about like the price to earnings multiples and, you know, where we kind of sit, because things are getting a bit elevated, even in some of these dividend ETFs, like they're starting to rise from where they were. I don't even think it was that long ago that the price to earnings on like SCHD was lower than 17, because it's sitting at 17 and a half. I do remember being quite substantially lower, maybe by a few points. But same with like VDY, right? Like VDY has been on a tear recently, and now its price to earnings is you know, pumping up here. And this is only as of September 30th. Like even these price to earnings from these portfolios are widely out, you know, backdated by a month almost. Yeah, 15.2 on VDY. It's probably 16 or 17 or higher if it was updated in this very moment, I would imagine, because all the stocks have rallied so much. And we all know the S&P sits at a PE of 29. And if you're new to investing, in simple terms, the price to earnings multiple is the idea is the stock or the company doesn't make any more or any less money moving into the future. It would take 29 years for you to get a 100% rate of return. So for you to double your money, you know, 29 years, just look at it as like a year multiple. It's kind of the easiest way to do it. But you really kind of got to step back right now and understand that when we look at these numbers, they are very skewed by a huge variety of factors. And you can't take a base price to earnings multiple into evaluation at the end of the day. Like it's very hard. You can't look at it as a pure tool. Mainly because you got amortization and depreciation costs. A lot of companies have one-time expenses. You've got to talk about dilution that's involved. Like there's so many other factors that can wildly swing the price to earnings multiple, like the banks right now, for example, that are putting loan loss provisions aside. Their cash flow and their price to earnings multiple is purely based off that cash flow that is going to change dramatically depending on how much loan losses they have to put aside. So you can kind of predict massive fluctuations that could play into those PE multiples, right? But when we take a look at the S&P 500 specifically, you know, that's up year to date 23.81%. Again, just kind of barreling back to that speculation of what is causing the valuation. And I think a lot of it has more to do just with the fact that we've been in such a suppressed market for such a long time. And I don't think tech is the darling that everyone keeps concluding that if tech crashes, the whole market goes with it. And I think that's the wrong way to think about it. And I've been telling people, you know, my conclusion is that as they cut interest rates, people are still going to want return on that money, and they're going to want cash flow on that money. So it's likely we're going to see some of that money, some of those savings accounts, some of those bonds, some of those GICs eventually trickle the way back into the market, where they're likely going to go into the more value. Because again, anybody buying bonds and GICs and all that stuff, they're more than likely going to be looking at aspects of the market that are cash flow generative, that are stable, you know, things like SCHD or VDY, those kind of stocks, right? That's what I think we're seeing right now to some extent. Because when I look at tech, right, like most tech, well, half of tech has been largely underperforming. Throughout the whole year here, Apple is up 22%, just barely trailing the market, but Microsoft and Google, you know, Amazon is barely just matching the market. Tesla, there's so many companies that sit in the big tech that are really widely divided, with the exception of semiconductors, which we're going to talk about here, because I think semis are obviously one of the factors really contributing to the higher price multiple in the market. But again, like even Microsoft and Apple trading at a 35 times, you have to understand that like if these companies can't really grow those earnings, it's hard to want to pay a 35 times, because that means even in these wicked rallied markets, you know, people start chasing stocks. And this is where you got to be careful with the smaller companies, because retail gets highly manipulated. It's almost, you're not really going to manipulate Apple and Microsoft. I mean, whales, mega cap fund managers, there's a lot going into a market cap like Apple. But when you look at companies perhaps like, you know, Palantir, a lot of the smaller cap companies that recently have been moving dramatically, that traded absurd multiples, that need like crazy moonshoots. Like you really have to understand that when you get, it's the same thing that happened to Tesla, right? I think Tesla's the best example of this, is when you pull forward too much information that, like, you know, we're promised is going to happen in a certain time frame and it doesn't, you start getting these periods, these lulls. And that's what analysts are calling for right now in the broader markets, is that in 2025, I think they're calling for a rate of return somewhere between like 7 and 10%. Like most of them are even coming under 7% because they think that so much of this future growth is priced in, right? And again, it's just really odd when you look because it's not like a congruent growth in tech. When you look down here, you see like financials have been crushing, right? Like you take a look at Berkshire and just so many variety of stocks like utilities have been on an absolute tear. Again, another place of stability. You see some precious metal, consumer defensive stocks are on an absolute tear. Some healthcare is like Eli Lilly. There's just been a really weird mix. It's not like it was post-pandemic, or even during the hyper market of the 2021 period. But we're just in a weird period right now where it's not like consistent across the board, and it's very skewed, which makes sense in the kind of market environment that we're in, just because we've gone through a very, highly sensitive market where interest rates, really control the outlook of certain earnings on certain companies, but do broadly affect all companies. Because at the end of the day, if you have liquidity, if you have access to liquidity, venture capital, small caps to large caps, people spending money on Google ads, all of that can boil down to some extent to interest rate sensitivity, right? So it's going to be really neat to see, what happens and how overvalued, the market is, because again, anytime we get these hyper spikes, and again, is it efficient market theory? Are we just kind of getting too much cash flow running into this right now? Like there's a lot of speculation on, as we head into earnings, can we justify this today? And I want to talk about where earnings currently sit, because we know companies like Tesla being outliers aren't really good examples of this, but unfortunately the rest of the market to some extent has to start justifying 30 PEs if people are going to keep hyping their way into this, right? And again, as we take a look, tech might be the primary thing holding up the high valuations, but it's the lower half of the market that is highly contributing to a lot of the growth that we're currently seeing as well. So next week, we do have some pretty pivotal earnings. Obviously, I'm really going to be paying attention to Verizon, GM, 3M. There's so many cyclical companies in consumer defense and staples, and CN's posting and things that you should be paying attention to outside of tech, because I'm presuming if things like Lockheed and all these, like even if GE that's been on an absolute tear consistently perform well like they are right now, then we're going to get a justification to the value in the market, right? And I just want to show you how, like, again, it's not always tech. And I think people keep getting skewed. If I show you this chart and I ask you, like, what company is this? Look at the moonshoot here. We're talking about a company that in 2015, let's just kind of take a low of 2015 here somewhere. You'd be up 261%. And, it's almost 10 years, or probably about 9 years there, right? That's a pretty damn good return. But if I asked you what kind of company do you think this is, what are you going to say, right? Would you really guess that this is JP Morgan? It's one of the largest financial institutions. It's also like pretty much the S&P top 20 stocks, almost S&P top 10, trading at a 12 times multiple right now. I'm just saying, like, you can't write these kind of companies off when they're posting like incredible growth right now. Now, it's not all banks. Again, it's somewhat cyclical, but this is not a tech company yet. You go back to 2023, same quarter, 38 billion versus 50 billion that it's running today in revenue. You look at the annual revenue growth, right, from 119 billion in 2020 to 154 in 2023. Again, it's not tech, but when you get normal companies like this that have this kind of growth behind it, yeah, I don't know if it justifies a 30 times multiple, but it's still incredible growth. Heck, like we just saw Netflix post, right? And Netflix is still proving that it's nimble enough in this really competitive market where I still think streaming, YouTube, I still think are going to dominate over long periods of time. But, Netflix, this company that overtook Blockbuster and, has a very long history is, I can't get over, look at the drop. I wish we saw more recovery like this and things like Shopify, because, you really would have thought this was the peak of the bubble. And then it just proved that, hey, Netflix, hey, we ain't in a bubble, not here at Netflix. We're going to fix this. We're going to figure this out. And they did. And here we sit, man. Look at the growth rate on Netflix right now. We're talking about going from, 8.1 billion on the quarterly in 2023 to today where we're sitting at 9 billion, right? Which is crazy. And we haven't even really talked. I don't even think this is including the recent quarter, is it? Because this is the half year in. So, we're not even talking about the last quarterly earnings. But again, you really got to take this into perspective, right? Because, Netflix is a bit expensive, but it's growing. Same with TSM. Like, we're going to talk about chips because we've seen kind of a whiplash here that I think opens up, buying opportunities. Now, TSM obviously went to the moon. TSM is like probably one of the most predictable companies because it posts monthly revenue numbers. Unlike many companies out there, we get to see what this is already doing before earnings. And that's why I'm so surprised that the stock jumped up so much on earnings. Because again, I can just literally just go search TSMC monthly revenue And it's just like, I mean, how did you not expect them to post good numbers? I mean, they literally have been saying we did 39% growth, 33% growth, 44% growth for the last 3 quarters, or the last 3 months in the quarter. So, I mean, like, come on, guys. Like, why is the stock running up so much? It's like, should have expected some pretty decent numbers here. But, I mean, the chip sector is still a darling across the board. AI, all this shit, still running. Not much to worry about here. The high multiples are going to get justified. When this comes to an end, who the hell knows? Hopefully the multiples come down and, they start leveling off and we don't see like a wicked correction, because all of a sudden the world wakes up and is like, oh shit, we're not making enough money on AI right now. We're going to have to cut back some of the expenditures or whatever. But, that's what a lot of people were saying about ASML. And the reason I'm saying ASML is a buying opportunity here is because, it's trading at a 35 times multiple. Again, presuming you've done your homework and you take a look, because it could be lower than that if they're writing off anything or there's depreciation of assets or whatever. But let's just say if at its base value today, the stock is tanked miserably. And one of you were asking me, like, what happened to ASML here? And I think it's probably one of the more interesting stories. And I want to read into their guidance, because I think their guidance really gives kind of a shining light on where we're going into the future, obviously, especially with these chip companies, because it's kind of fucking wild. But yeah, I mean, their net sales were great, from 6.2 billion to 7.4. I mean, if you take a look at their net income here from 1.5 billion to 2 billion, I mean, the growth numbers here, these are in the euros too, by the way. So, I mean, in the millions of euros. So, I mean, we're talking about real numbers and real growth here. Like, these numbers are, disgusting, to say the least. Like, these are incredible growth numbers. For a 30 times multiple, this is fair. Like, this is really decent. But what I couldn't understand is I was reading headlines, right, which are absolute bullshit. Anytime I read like a friggin' Bloomberg or whatever article, like, it's so dumbed down, because they were like, oh, they lowered guidance. So I'm like, okay, well, let's read their guidance. Our third quarter total net sales came at 7.5 billion, above our guidance. They already beat guidance, driven by DUV and installed base management sales. The gross margins hit 50.8% within guidance, which is insane. Like, Apple wishes they could get those kind of numbers. Hell, even Nvidia is at 70%. It's disgusting. While there continues to be strong developments in upside potential in AI, and other market segments are taking longer to recover, basically. It now appears that the recovery is more gradual than previously expected. This is expected to continue in 2025, which is leading to customer cautiousness. Regarding logic, the competitive foundry dynamics have resulted in a slower ramp of new nodes at certain customers, leading to several fab pushouts, resulting in change in litho, which is probably the lithography machine demand timing, in particular the EUV, or in particular EUV. Now, in memory, we see limited capacity additions, blah, blah, blah. Go into a few more details. We expect fourth quarter total net sales to be between 8.8 billion and 9.2. This is the fourth. We were just at third quarter. The third quarter came in at 7.5. I mean, the growth rate here is disgusting. So I'm like, why is the stock tanking so much? And it has a lot to do with obviously stuff they're mentioning here, coming in lower than expected, lowering guidance into the future, which nobody wants to hear, because analysts are always right. I mean, these guys get on their soapbox and somehow they make a price. And even though the earnings are good, they miss price or miss guidance and the stock tanks, which makes no goddamn sense. But here, I'm just saying, like, you look at this company and yeah, they're having some slowdown in market demand because they can't really sell in China as easily now. They have some restrictions and, there's a lot of global issues, but even in the fact of all these global issues and all these problems, it's still expected to do over 8 billion, just next quarter. At a 30 times multiple, that growth rate is pretty astounding, right? I'm just saying it's kind of a wild, just trying to wrap your head around this right now in this current market environment is one of the craziest things I've ever tried to do. I really miss, the old days. The new days are crazy. You sold your TD. Oh no, I'm still buying through VDY, and we'll see what happens though. We'll see what happens. These streams are like a job family commitment. I appreciate that. I feel like I'm a little off my game today. It's been a long weekend here of doing a lot of stuff. Me, Telus, and TD. Yeah, and I keep getting reamed out for Telus here too, right? And this comes back to the point of, like, again, I am not a genius, okay? Like, I can only read what is available to me and try and digest it. So when I look at a company like Telus, and same with like Verizon and a lot of these companies, but Telus specifically, because I've actually read the fucking earnings, unlike so many people out there, and I hate arguing about they can't afford the dividend, they can't do this, they can't do that, the price to earnings is through. Okay, what you have to understand is the company knew that they were going into a higher interest rate environment. Things were going to get expensive. We've seen the cost of the infrastructure bills, because they have a lot of debt, go up, obviously. That leads into the bull case that when they cut interest rates, they're going to be saving millions of dollars, like tens of millions into hundreds of millions. If we get back down to a modest 2%, 2.5% interest rate, like, I mean, they're going to get a lot of cash. But then the other thing you have to look at is they laid off thousands of employees. And when you, as a company, decide in Canada that you're going to lay off thousands of people, guess what happens? You have to provide severance. Some of these people might have been working there for 5 or 10 years that got fired. That severance could be up to 12 like they could have to pay a full year's salaries to some of these people they laid off. They have to pay severance. So when you look at the money that they've had to set aside to pay severance and restructuring costs, and the CEO mentions this in the earnings, and you understand that this is going to cost tens of millions, if not hundreds of millions of dollars in the short term, you have to understand that the earnings has to come back from this. Like, they have such stable revenue, right? So if you take a look, and this is how you can play out these kind of companies, right? So, I mean, I just use this as an example, but you could apply this to so many stocks right now. But you take a look, because so many companies went through restructuring, right? The big tech companies have the margin to do it a bit easier, but here's like the revenue. Look at the revenue, right? Like, they've recently just seen a bit of a stall out. Revenue's kind of flatlining. It's not really going anywhere, but who cares? It's been going up through the entire interest rate cycle. And then you go take a look at their earnings per share, right? It's just plummeted, and the stock has been following the earnings per share. But now we've leveled off, and something tells me when we hit the new era of low interest rates and no more restructuring costs, that this is going to start to recover, as we've seen it happen with so many companies, right? I mean, it's kind of like an ebb and flow. It's like, you get your yin and your yang. It's like oil going negative in the pandemic and then rebounding to all-time highs. It's just like you get this influx of demand, and it causes these whack events in some companies that are infrastructure, things like this. So I find it really interesting. And I want to have real arguments and debates with people about it, because I want to know if I'm wrong. But when people are like, "You can't afford the dividend, don't buy," and I'm like, well, I'm not telling you to buy it. Obviously, you can get it through your ETFs, whatever. It's just a huge Canadian company. If you want to take the risk and buy it individually and lock in a good yield, I mean, let's argue it. That's the debate. That's what's so interesting about it, right? But I don't know. It just blows my mind how little work people put into just reading a few notes. Sold half my BNS. Why are you guys selling your banks? They're rallying a lot. Lads, I just want to do ETFs now. Set it and forget it. Yeah, no, I love just buying ETFs, but like, even at scale, once your portfolio gets big enough, you got to understand like what's in the ETF. And if you're like me, like, I still think I'm holding the stocks, and I'm just a nerd. If you want to be purely passive, set it, forget it, walk away. But obviously, like, I love sitting here and just nerding out on a Sunday before work on like, what am I holding? Like, is Apple justifying, the valuation of the S&P right now, or is it the other parts of the S&P? And then, sometimes I'm still trading if something comes into favor, because even though like efficient market, theory might come into play on some extent, sometimes the market short-term votes stocks out, like they are with ASML. Like, does ASML deserve to be down 33%? No, I don't think it does. So, it could be just an overreaction. Who knows? Never too late to just buy the dips. What dips? Yeah, maybe in Telus, but I mean, frig, I haven't seen real dips in a while. I took a chance to play the banks. Oh, nice. We're retired magician YouTuber. You've been around for too long, dude. God, I haven't given the magician backstory in a while. Telecoms are my worst performing. Yeah, they've been doing pretty shit though, to be fair. And that's the risk, right? I mean, so unfortunately, a lot of the market returns come from timing, because some people buy a stock and they see something like a 2019 to 2020 Tesla gain, and then some people buy it in 2020 and then don't see anything for the next 5 years. Or some people buy the dip or went down to 100, rode it up, and then sold out. I don't know. Like, a lot of luck and timing does come into play, right? You do have to have an itchy trigger finger, though. I know that much. I think Canada is in a recession. Yeah, I mean, it might be. Not yet, but we're damn near close. If you look at Canada's GDP, and I'm surprised the States have held up so well. GDP chart. So in order to be in a technical recession, you need 2 consecutive quarters of negative GDP. And this is not the chart that I want. Let me go find. It is slowing down. Yeah, this is what we want to see here, to some extent, right? Like, we've been really lagging on GDP growth. If you zoom out on this and you look, like, this is not. It's not exciting to be growing at, like, just to compare it to the US. I mean, our GDP is growing at like 0.5 percentage point. At the lowest, at the Q4 of 2023, we had absolutely no growth. We could have been in a technical recession last Christmas, really, if we had 2 negative, but we haven't had 2 consecutive yet. But what does it look like for the US right now? Because I know the US GDP growth chart is much higher. Our GDP chart. I don't know. The U.S. is, really rode through this. I'm really hoping this is the first soft landing we see. That's not what I want. I think we want the month-over-month numbers. I don't want the total GDP. Nope. One sec here. Month over month. Okay. I think it's quarterly or monthly. Let's see here. Can we find this? Damn it. Give me the quarterly. This am I just missing something here? Show me the quarterly. Why can't I find? There we go. Yeah, look at the GDP here in the US. Isn't this crazy? Like 3 percentage point growth. Like even in the backdrop of really bad inflation, if you have GDP growth like this, like you're popping, baby. Like you're doing pretty good. Like they haven't even seen close to recession in the US yet. Canada's just on the brinking line. Now, again, it slowed down, right? Like last quarter, it was 1.6. Or for 2 quarters, at the beginning of the year, 1.6% growth and then 3%. And for those of you that don't know, gross domestic product is just the exchange of commerce, right? Like when I buy money or when I buy something from you, the government gets their tax dollars. It's all goes to GDP. It's all calculated in GDP growth, right? It's really interesting, right? It just shows how healthy an economy's spending is, and is it lively? Is it growing? Is it vibrant? I mean, look at the pandemic, right? Like this is why they did helicopter money. This is why we got inflation. But again, it's like the ebb and flow, right? I mean, you get these massive influxes where if you're going to drop this much, you're going to have the yin and yang, where you're going to have the recovery of an insane percentage. So, I mean, when you get unusual events like this is where most people get rich. This is, in fact, where I got really loaded. I mean, the reason I was able to buy a property in Toronto was because of this. I mean, I remember this day so specifically in March and in our chat groups. Actually, this was the first time ever that I used a margin or a line of credit. I remember I was buying stocks on line of credit because things just like tanked so miserably, and it worked out so well. Anytime the market drops, most rich people from the stock market I meet, we actually reminisce so greatly about the periods where the market tanked, because it seems to be what you do when there's blood on the street is more important than what you do when the market's performing well, because most people psychologically want to sell. So if you have the balls to buy, right? Like, I mean, it's in the last crash, all the way from basically the dot-com era. I mean, if you bought any of those major drops, holy shit, you did exceptionally well. Kyle, talk some sense for me here. What do you think? I hold Clover Health. It's up like 315 this year. And I always hear you say take profit if it's up over 100%. If you make 100% return in a year, you have to take profit. It is just like the general rule of thumb. Like even, that's how you have to. I mean, these days I don't even hold anything to 100%. Like I had to take profit long before that. I'd love to see the gains on my wife's meta position though. I think she's crushing it. What do you think? Clover. Let's take a look. We'll just take a quick look at Clover Health. Honestly, at 315% return, it depends on how much money you have, right? To be fair, like I sold Apple, and I was selling it once I started getting like a few hundred percentage gains in it. I mean, wow, this has done exceptionally well this year. Yeah, you're gonna have to come to this own decision on your own, but it's a $2 billion company. The market cap, is relatively small. If I was owning something like I kind of say this with like a Duro, right? Like I'm up pretty decently on a Duro, but I don't know if I'm up 300. Like, I mean, the rally in this is nuts. If I started getting 400 or 500% gains like this, I would probably sell half the position, or at least pull my initial investment out at this point. And like, I don't know, I wouldn't have the balls personally to hold this. Because again, like there's so many examples where people are like, look at my bagger, I've done so well. And then GME happens, right? Where all of a sudden it tanks. And look at Canopy. Like one of my best trades ever was Canopy Growth Corp. And it was the first stock I ever bought. And I'm not saying that's going to happen to the stock that you hold, because obviously you could get like a meta where it just flies up and doesn't stop. But in most cases, this is what happens, right? You get one of these historic bull runs and then boom, like it literally goes back to where it was when I bought it, which is kind of wild to consider. I mean, this happens a lot. You don't want to end up in this position. This is why you take profit. When you own individual stocks and you get baggers, man, you got to run with it, because then you can gloat. I made 100% bagger. You can put it on your wall. It's like, I think I've only got 5 or 6 of those over the course of 10 years. I found 5 or 6 like multi-baggers. And like, I almost want to frame the trades. Like I have the trades in my investment account, and it'd be fun to be like, hey, like, this is possible. It happens to people. You're going to start a position in ASML. I'm not personally. I feel like I missed the chip sector, but I don't mind having my NVIDIA exposure through the S&P. But I'm just saying, when I look at it, it doesn't look like unreasonably a good buy at a 30 times multiple for the growth that you're even getting in the last quarter of this year. Like that price to earnings is going to drop pretty dramatically if they go from 7.5 billion to like 8.5 to 9, just within one quarter. Like, I mean, that'll drop I don't know what that's going to lead for earnings. I didn't look at the earnings estimate, but obviously it's going to probably increase the same percentage. Yeah, a little swinger for sure. That's what I do, right? Like sometimes I'll find those plays and I'll swing them. But I honestly, the only stock that I love a lot is Tesla, and I'm waiting and hoping it comes back down. It might not. I don't know. It's got a lot of hype built into it. Like I find a handful of stocks that I love with a passion, and then I'll just trade them when it makes sense. But I don't have to hold it. I have no remorse. If this thing shoots up dramatically, I'm so scared, and I just love my money so much at this point. Once you make a lot of money, you care for it. You care about all of it, the pennies and the nickels and dimes. So you get the dollars, but you don't want to fuck with the dollars either, right? Like you're like, man, once you get the dollars, you're like, I have so many of them. How can I just get a really stable, good return without taking on too much risk? So it's like I become conservative in my age. Love your family, not a stock. Yeah, exactly. Never get married to a stock, man. Yeah, but that's the problem with influencers too, right? Like I come in so passionate, like that's why people get pissed off, because one day I'm like, Google's the best thing ever, and then I'm like, a week later I'm selling it. And it's like, it's the sales pitch that you hear from all these people on YouTube right now, right? It's like, honestly, this is the same thing with the Palantards. Like, we've got so many cult stocks, and they just don't want to admit that it's a cult stock. Tesla's a cult stock, Palantir's a cult stock. You find your passion with these, but you have to recognize that they get super fucking expensive for no reason because they have a cultish vibe around them. When you have YouTube channels that are purely dedicated to a stock, I don't hear a lot of YouTube channels that are dedicated to fucking Pepsi, okay? I'm just saying, when you get a whole slew of YouTube channels that are dedicated to just one stock, that's when you've got a cult stock that is likely going to be sitting mostly in overvalued territory, because there's just going to be a whole bunch of people that don't give a fuck how expensive it is that are just going to buy it for the sake of buying it. I mean, look at dumb money. That's how they operate. They don't even care about valuation. They just care that people are buying it. It's like a literal way of investing. It's called, or what they call it is social arb trading, which if socially all of these people are piling into it like a Pokemon card, or like crypto, right, where it becomes kind of a Ponzi, where so long as there's someone there buying it, you're good. Maybe we'll do a family reunion. I'm going to Vegas next year. I think we're doing Vegas next year. Maybe we'll post a little note. I actually been meeting up with chat group people too, by the way, which is really weird. I haven't done that in a while. Some of the guys in our chat group reached out, and I actually went and had a coffee with one of you, which was wild. It was really cool meeting up with some of you guys. I'm a friendly dude, man. You just shoot the shit, shoot me a message. It's all good. What do you think? Monster cult stock? I don't know. Monster Energy, is that the one you're talking about? Monster's come a long way though, right? MicroStrategies. Is that the one? Sorry, I thought you were talking about like Monster Energy or something. Micro. Yeah, I don't know. It's a good question. Hard to say. It's a big company. These companies are getting pretty big. I don't know. It's really, really hard to tell, because crypto is so still kind of infancy and early stages, man. Like I said, we own some Bitcoin. I don't look at it anymore. God knows we're up probably pretty decently on at this point, but man, what are your guys' thoughts on crypto, man? You guys still think it's a fraud? In my heart of heart, I believe almost all of it is a Ponzi, with the exception of the businesses that I see being created that don't exist yet. Like, we were just talking about this yesterday. Like, why is there no video games right now? Like, we were talking about RuneScape and some of these games where they have like a lot of manipulation to the in-game stuff, because the developers don't want you trading this shit off platform. But because like some of these games have in-game stock markets, almost, they get manipulated, and it's a fascinating fucking case study when you look at it. And like, we were just talking about, like, why haven't games yet let you take the in-game shit and sell it out of game? Like, this was Mark Zuckerberg was talking about this like years ago, and we still don't have it. There's a lot of problems that obviously arise when you think about it, because some guy could cheat at the game, get some in-game thing that's worth a lot, and then sell it at auction or flip it as an NFT, and then you can't get it back. I mean, that's a possibility, but I feel like the world wants to evolve so abruptly, and it's killing me inside that it's not, because things just take time. We have to be patient, right? Like self-driving cars. We heard about that in 2019, and here we are, and Waymo's the leader right now. Things just take so much longer, and that's where you kind of get these overextended values in the market, which can be concerning. I don't know how to round this conversation off to come back to what we were talking about. Like, if we're truly in an efficient market where all the information is justifying the current value, or are we actually in an overvalued market that is largely being pumped up by chip stocks that are only being driven by sales from mega cap tech companies and not by end consumers. And is there a reality in the future where those sales start to lagger off? Because again, if they do, the chip stocks will slump dramatically. And if they're a huge sector of the market right now, we could see an easy 5-10% correction just from that in the broader markets. But anyways, where were we, folks? I wasn't even investing in 2020 when it crashed. I wish I was, but that's what got me. Here's the thing, right? Like if you're only just starting now, I'm presuming you're young enough, you're going to go through more than one of these. And now that you're like psychologically aware and prepped, you just understand that like it's going to be hard because fucking nobody wants to do it. That's why they're selling their stocks. But you really kind of have to just run in it with like your sword and dagger, man. And just, you know, even if like you lose your job or things are hard, sell shit. I mean, like usually when the market crashes, like I'm going so bananas, like everything around me, I'm trying to sell just to put it in the markets. And that's when I get so greedy. I'm using leverage, which is 2020. It was literally the first time in like 8 years of me investing where pandemic was 4 years ago. So I would have been investing. That would have been my 6th year in. But like I missed 2008 and I was pissed. And I was like, oh man, I'm never going to get 2008. And I had some good trades along the way. But like I said, when 2020 hit and we all went nuts and we bought everything, like the REITs, we were buying small caps, we were fucking just buying everything. And then 2021 it hit. And then we were just like getting rich. We were like, you know, everyone was just making money hand over fist. We were taking profit on everything. It was great. What a time to be alive. But again, you have to recognize it. So if you notice it now, psychologically, you're prepared. It's a long game. You got 30 or 40 years ahead of you. We're going to have this a lot more. It's going to happen again. There's always another one around the corner. You know, it's going to come. That's when you buy. Everything's on sale 100%. But you need one of those black swan events. And again, it's kind of a scary, you know, thing because you have to understand that like you're really playing the economic game where it doesn't really matter how bad it gets because the only tipping point that can really ruin you is that we actually go into a civil war, you know, a geopolitical event, something that actually deteriorates the entire economy to nothing. That's what it takes, right? Like, I mean, even 2008, you get bailouts, like all this shit gets covered up because we're such strong economies. We can print money. We're global currency leaders, all this shit. So anytime it tanks on something that sucks, you just have to recognize that this isn't like the straw that broke the camel's back. Like it's not the end of the world, right? So you have to take advantage of it. Like the pandemic, we knew the pandemic was temporary. Why did the markets completely like tank? Because earnings slowed down, but we knew it was temporary. Like it was the most common sense thing. It was like, yes, everyone's coming to a standstill. Yes, businesses are going to get hurt, but this isn't going to be like a 5-year thing where we're all sitting on our hands. We knew it was temporary. Same with like 2008. Within the first month of 2008, that financial crisis, like people are like, holy shit, the banks are going to bail them out. And then within like, you knew that information just as well as everybody else did if you were just paying attention. And I mean, let's just take a look at like SPY, for example. Like it took the market still some time to recover, but it was quick. You know, it's a lot quicker than people think it is, right? I mean, let's just take a look here real quick. Yeah, I mean, like, so we went through this period where, you know, the real drop was, I mean, how long did that even last? It was like August, September, October was like the major drop, and it bottomed out in, was that February? So within a 4 or 5 month period, you bottomed out. And then like, you know, you're pretty much, if you were able to buy some of those bottoms and cost average, you saw like 100% return before the market even hit all-time highs. That's why we're saying, like, you know, if you bought the top of the or like the .com or 2008, like it took a long time for you to see a rate of return. But this is where most people want to buy, is when everybody else is buying, not when everyone's selling. This is why cost averaging matters so much. This is why having like an emergency fund for when the markets tank. Like I said, that's why I have cash. Even right now, like I've still been slowly rebuilding my cash position a bit, and I've just been building that up. So if the market goes into another calamity event, I have extra money to double up those contributions. Because again, it matters more when it's psychologically, and everything about how you react in an event like that will determine your future so much more than it will when we're greedy right now. Because everyone's on their soapbox right now. We're all just, you know, throwing tendies in the air. We're all bragging about it. But this is where people FOMO. And then when the market tanks, they're like, fuck this. This was a dumb idea. Why did I do this? Because they have no patience, and then they don't buy the bottoms. And then it comes back and they sold. Like, you know, it's usually what happens. YouTube hyping up Celsius. No one knew how bad COVID was going to be. People were dying. COVID was bad. I hate COVID deniers because it was bad. It was really bad. Hell, we were just talking about this yesterday. We were at a dinner party, and I was just saying, like, it was so weird because I was up north, and if you guys live in Ontario, Canada, if you're near Toronto, I grew up in cottage country, and you might know a place called Bob Cajun. That was one of the first places that got devastated because some of these people, I think, that worked there came back from Florida or something. They were traveling abroad. They come back, they go to work, and then all of a sudden, these old people just started dropping dead. And I think it was for about 5 or 6 days. It was the third or fourth week of March for just not quite a week. Every day, there were several helicopters flying over our farm, my parents' old farm. And it was just wild because, like, there's no airport out there. And just every day, we're just hearing these helicopters. The windows are shaking, flying really low toward Bob Cajun, right? I wonder if they were picking them up in Lindsay because I can't remember if they were flying toward the Lindsay direction because there must have been a helicopter pad somewhere over there and they were just shipping all these people that were sick to Toronto. Yeah, it killed a lot of people, man. It fucked some shit up. That's why I hate people that are like, oh, it wasn't that big of a deal. It's like I lost personal friends that weren't even like COVID related. It was just because they couldn't go to work. They got stuck indoors. Some of them had heart attacks. My mom's friend hurt her leg when she was gardening and she didn't want to go to the hospital because, again, who the hell wanted to go to the hospital in the middle of a pandemic? And she died from like a blood clot, like within 2 days because she just wanted to go to the hospital. I'm just saying, like, it was a rough time psychologically too, right? Biggest holding is Bitcoin. Good for you, man. Video game economics are manipulated by bonds. Sorry, I don't want to backtrack too much. I'm going on too many tangents this evening, folks. I appreciate y'all stopping in. Stay cool, stay lit. I look forward to earnings next week. I'm going to stop rambling, collectivize my thoughts, and get back to work and keep hustling. I want to see you guys retiring young, baby. We're going to get there. We're all going to get there, man. I love seeing the chat group. Fuck, some of us have been around for years now, and you guys are crushing it. I just can't get over how simple this shit is and how easy it's been. You guys got to understand, you all can do this so easily. We're all getting rich for no reason. It feels like it's awesome. Yeah, brother. I love it. Let's stick with it, boys. Keep the strategy. Stick with it. Let's fucking get there so we can all live it. I love seeing everyone around me do well, man. I hate people that aren't being prosperous because none of this depressive, I can't do this shit. We can all do this, folks. And then we got to party it up somewhere and actually meet up and get a little commune going together here so we can get some weird like old person like wine group where we're like testing wine, but we're really just talking about stocks for no reason, like a bunch of old farts. The kids won't understand. Peace.